Welcome again to everyone joining us. My name is Tim Ogden. I'm the Managing Director of the Financial Access Initiative at NYU Wagner, a research center focused on how financial systems can better meet the needs and improve the lives of poor households around the world. And today's faiVLive is a conversation about building inclusive financial systems, inspired and in conjunction with the Financial Security Program at the Aspen Institute. The Aspen Institute's FSP has been working on questions of household financial security for many years and recently produced a report called Building an Inclusive Financial System that is the inspiration for this conversation. I'm also joined today by Rashmi Pillai from FSD Uganda, Payal Dalal from the MasterCard Center for Inclusive Growth, Mayada El-Zagbi from the Center for Financial Inclusion, and Indradeep Ghosh from Devara Research. You can find all of their details and more titles and bios on financialaccess.org, a blog post that we have for today, with links to their more information and the Building Inclusive Financial Systems report, as well as some other resources. Quickly before we get started, if you're interested in following future faiVLive conversations, or the mysteriously absent Five newsletter, you can subscribe on our site. We also have a series of research related to these topics you can find on our site, and a quick advertisement for one of the major research projects we have going on now, which is focused on small firms. Also a quick advertisement for the upcoming MasterCard Global Inclusive Growth Summit coming up on October 14th. This conversation, this faiVLive, is part of the Household Financial Security Insight Community, which is supported by the MasterCard Center for Inclusive Growth. If you're interested in this conversation, there'll be a lot more conversations like this at the Global Inclusive Growth Summit, and you can see the registration link there. So I'm going to now stop sharing. I'm hoping I was sharing. Maybe I wasn't. And there we are, and get to the rest of today's conversation. So I'm going to start here somewhat going against type for me. In the description for this session, I talked about the progress that we've made in financial inclusion, that about the time that FAI was founded was around a particular paper that our founder, Jonathan Morduch, put together called Half the World is Unbanked. And according to the latest FinClusion surveys, we've cut that number dramatically and now could say less than a third of the world is unbanked. And that's not necessarily where we want to be, but it is substantial progress. So I'm going to go against type here and start us off with the conversation just by asking each of our panelists, what is the biggest success of the last decade of financial inclusion? I normally start off with when everything's wrong. So today we're going to start on a positive note. What's our biggest success in the last 10 years? Mayada, why don't we start with you?
Great, thank you. And I was able to unmute myself, which is I'm so proud. All right, so to me, it's pretty obvious, at least in the international space, and that's what I will speak about, which is really the story's been a story about mobile money. And when you look at the data, just the kind of exponential increase in mobile money access around the world, particularly in Africa, is pretty remarkable. And GSMA's State of the Industry report, came out a couple months ago, and it really, you see these big, these massive numbers. So 1.2 billion mobile money accounts were registered last year, just in 1 year. It's pretty incredible. And then the number of active users is remarkable, 300 million monthly active accounts. And then, one of the things that they highlight, which I think tells you a little bit about the last decade. So it took 10 years to achieve the first 100 million active accounts, and it only took 5 years to triple that number. So clear momentum there. So I think the story has really been a mobile money story, at least internationally.
Rashmi, East Africa is one of these great mobile money success stories, probably the genesis, possibly along with Bangladesh, as the mobile money revolution. Would you agree? What do you think the biggest success in financial inclusion in the last decade has been?
I agree with Mayada. But I would reframe, from my perspective, I would reframe that the biggest success has been non-financial institution-led financial service delivery. So it is not just mobile money, it's e-money issuers, it is fintechs, it is non-bank or traditional, what you would think of traditional financial institutions. It is actually the opposite set of actors that have delivered financial inclusion.
Payal?
Yeah, so I think, look, we have made a lot of progress. Absolutely, mobile money, as Mayada talked about, true. I also think there have been new business models and lots of new technology. And I also think we've seen a growth in embedded finance that's really reshaping distribution models for financial services while still creating a role for technology companies in the financial lives of individuals. So I can think about e-commerce platforms that are offering integrated payment processing and lending services to their sub-merchants, ride-sharing companies like Uber and Grab, fintechs that are offering so much more functionality, and of course, telcos with digital banking products. So some really good news stories in terms of totally integration. And I think it leads us to getting beyond access to usage, which I'm sure will be a theme that we will all talk about. But I think this technology has helped us get one step forward from access.
Indradeep.
Yes, hi, Tim. So I'm going to speak from an Indian perspective, since Dwara is mostly focused on the financial inclusion arena in India and also social protection. But I think from our perspective, in the last decade or so, the biggest shift we have seen, which we think is a significant one, is a shift in thinking about the household as the highest resolution economic unit of analysis. And I think that this has been an important arc for financial inclusion activity in India to have traversed, because it's been many years now that folks like us at Dwara have been pushing for a sort of household level assessment of both income as well as expenses. And recently, the Reserve Bank of India released a document, a consultative document on the regulation of microfinance, which finally gives voice to this sort of call for household level income assessment. All regulated entities are now supposed to have a board approved policy for household income assessment. Caps on loan repayments are applied at the household income level. So I think this has been a significant element of success as far as financial inclusion in India is concerned.
Ida, I do want you to answer that question too, but Indradeep's comments are sort of also a lead in to this question as well that sort of led to the recent report. What is an inclusive financial system, and your work on household financial security and how we should think about what an inclusive financial system is. So why don't you start with what you think the greatest success is, and then we can head into a conversation of what is an inclusive financial system, is how are households part of that, and how should we be thinking about measuring inclusive systems?
Yeah, sure. It's such a pleasure to be here with this great group. Indradeep, I can't agree with you more that the idea that the household is the foundation of strong, resilient economic growth. It also, by definition, is part of inclusive growth, but the idea that you're centering a macroeconomic conversation on household financial security is still profoundly an outlier, I think, in the broader way that we think about economics in the world. But I do think that the folks on this call, focusing more and more on household financial security, and I think adjacently on micro business and microfinance, that these things are, as we see after the pandemic, critically at the center of the conversation, which is why I'm so hopeful about this conversation, and also why I think the paper that we did and the working group that we convened was important. I actually think, Tim, the successes I would point to are also international in terms of what's the biggest success in the last 10 years, because even in the retirement industry, I often say the US is a good net exporter of great ideas. We're not often the first ones to implement the way that a solution gets designed to solve the problem of a low income or a poor population. So in many ways, we have proliferated in fintech, but the ways that mobile money is working in the US are far behind, the way that it's working in the rest of the world. And so I just want to put that out there. And then just to your point, to just throw this on the table for a conversation, when we try to shift the language, and we're certainly not the only ones doing it, from financial inclusion to inclusive financial systems. It's part of that, piece that Payal was talking about where are we going with this. But I think it's also about understanding that if you are going to center on the household as a driver of economic growth, then we need to understand what systems interact with that household's ability to not just access financial services and products and utilize them, but reap the benefits of a full set of products and services. So that's what we say. We say an inclusive financial system provides all people with the ability to access, utilize, and reap the benefits of a full suite of financial products and services that facilitate stability, resilience, and long-term financial security. So that's a broad mouthful, but that's as pithy as we were able to get in the report.
A challenge always here is how we use language to both communicate quickly and effectively, but also, what that excludes or the nuances that it excludes. And there's so many little threads that I want to pick here, but I'm going to skip to something that strikes me, but on these answers about mobile money and non-financial providers, because I think it relates to this. What is an inclusive financial system? Because if someone gets access to a mobile money account, but is still shut out of the rest of the financial system, that's not an inclusive financial system. If someone, if we have fintechs that aren't sort of plugged in to a conversation about household financial security, we're in some ways right back to and I'm going to first raise my hand. My center is still called the Financial Access Initiative, right? Like we're 3 or 4 generations behind on the hip terminology in the space. So I'm just getting, eventually we're going to come back around. If I wait long enough, financial access is going to be the new term again. But specifically though, I want to talk about that, when this half the world was unbanked idea came along and sort of galvanizing from the early 2000s, from my perspective, a lot of that was getting the global development community sort of latched around the idea that access to financial systems, access to financial tools really matters for development. It's not just about health or education or some of the other things that were focuses, that the financial system matters even to the poorest. At the same time, Mayada, as you point out, the real action in the last 10 years in going from half the world is unbanked to 30% of the world of unbanked isn't the same institutions that got us to half the world being unbanked. The microfinance movement. So I want to sort of throw this out, Rashmi particularly, and Jaideep, both because I think we see this most specifically right now in East Africa and in South Asia. Do we still need those institutions, or have they been bypassed? Are we going to get that remainder with new entrants and different kinds of developments? Or is there still a role in closing the last financial access gap with it feels a little funny to say the traditional players, which were the innovators of the 2000s.
I don't mind starting, even though you didn't want to hear from me. So look, I think, a lot of the prevailing dialogue right now is about fintechs, right? And I think they are revolutionizing the way customers engage with and benefit from financial services. And yes, I would agree that established financial service providers are really burdened with legacy business models that are often high touch. They have these existing structures and relationships that really complicate their efforts to adopt new technology. But I think financial service providers know they need to adapt. And what I'm seeing, at least from kind of looking at MFIs and our work around digital transformation of microfinance institutions, is that especially during the pandemic, we've seen an acceleration of unlikely bedfellows between fintechs and MFIs. And so fintechs are helping microfinance institutions innovate, while these MFIs are helping fintechs not only earn local trust and be part of local communities, but also think about how you blend tech and touch. Because I know we've done this mass acceleration to digital, but in all the programmatic work we're doing, I can tell you we're never going to be a fully digital economy. We're going to have some blend of tech and touch. So I think this is really interesting in the sense that I don't think the old guard is dying. I think they're just finding new ways to cope. And this is coming into new partnerships.
Can I jump in? Oh, sorry.
Go ahead,
Sorry.
Rashmi.
So Tim, when it comes to the metric of percentage of adults worldwide unbanked, at the risk of being controversial, I just think it's a redundant metric. That's not how people are engaging with financial services, especially poor. Therefore, first port of call is definitely not deposit-taking institutions. You're not going to engage with the formal financial sector if you don't have income. That's why you will see a higher percentage of women engaging with informal savings groups or SACCOs and producer cooperatives. That's where low-income people are engaging with first. The next port of call is how do I increase, credit so that I can increase my take-home income? I can reinvest whatever I'm doing, whatever economic activity I'm doing. And when I graduate to a level that I can pay for monthly account fees, annual fees, and all kinds of transaction charges that banks have as a revenue model, is where most people think, oh, that's for the middle class. So as a metric globally, percentage of people unbanked or banked is not really relevant. It is percentage of people interacting with payments, credit, savings, insurance. And that's why I said that it's a very different world. And I think Payal, Mayada, Ida, and Inderdeep's comments all come to that maybe even the kind of metric of success needs to change.
So let me jump in because I totally agree with you. And I actually wanted to just add and say the future of the traditional players is partly dependent on the story we tell and the data we use. And I think that the reason why mobile money is the winner in my story is just because I'm using a very basic metric, which is the same metric you started with, which is, as Rashmi just said, is the wrong metric. So that is what's driving the conversation. In a sense, it's we're being led by a discussion of metrics and actually the wrong metrics, which is unfortunate. If we actually cared about people's well-being and other kind of, the household that Indrajit just talked about, and if we were actually looking at the things that matter for that household, then we wouldn't be, mesmerized by this half the world or a third of the world is unbanked. We would be looking for other things that show us how households are benefiting. And so I do think that it's a language story, it's a measurement story. And then what happens is we're all kind of crowded in towards something. So, in your original kind of, outline, you wanted us to talk about the failures, because I was going to say, actually, the focus on transaction accounts is the biggest failure. And it's precisely mobile money is both the success and the failure. Because we are so focused on getting that account, we have stopped focusing on what's good for people. And that's a problem.
I'll jump.
Yeah, go ahead, Ida.
Echo it, I think, with just maybe just putting a finer point on that. I do think that part of what the working group we had that led to the paper, that at least is the whole goal here, is to incite conversations like this in a lot more places, right? So, and especially among finance ministers who are probably going to have to talk to other non-finance public servants and private sector around how do you solve, because if you actually, so what you're saying, Mayada, what you're saying, Rashmi, is, we've focused on the form, right? The form of inclusion was banking. And now what we're doing is flipping that on its head and saying, what are the functions that facilitate people being fully included? And so on the one hand, to Indradeep's point, saying not just financial inclusion, but social protection, we have certainly seen post-pandemic that one of the functions is facilitating government payments, but payments in general, to your point, Rashmi, we lay out 4 in the paper. Payments, they're the ones you just said, payments, credit, long and short-term savings. We talk about both the liquidity needs and the ability to leverage into longer-term products, and the insurance piece as well. And I think when you actually look at those functional needs that households have, I just wholeheartedly agree that the set of ways that we need to think about success have got to fundamentally change.
So, Indradeep, this sort of thread too that Payal introduced of, we're never going to be fully digital.
Yes.
India attempted, did demonetization, had this sort of sudden experiment in reducing the use of cash. Are there lessons for the rest of the world and how digital transitions happen and the fallout from digital transitions and what the limitations of those digital transitions from demonetization?
So the demonetization event is, I think, still being studied, and we are still trying to piece together what exactly happened and how financial inclusion may have played a role in both the transition from that shock to a state of stability and beyond, because we have to remember that after demonetization, there was a whole lot of liquidity sitting in the banking system. And that produced a crisis, because all of that had to be loaned out, and so you had a credit boom after the demonetization event. So, I mean, the macroeconomics of demonetization, I think, overshadowed in many respects sort of the digital story, that also that there was definitely a digital story or a digital side to demonetization, but there was a larger macroeconomic story that was playing out that in some sense overshadowed that digital story. I think in India that, both in payments as well as credit, we need, so the way we think about it at Dwara is that if you think about the financial system as a whole, if the objective of a financial system is to originate risks, transmit risks, and aggregate risks. So these are the three functions that a financial system needs to perform. And so we think of the financial inclusion story at a systemic level to consist of the following. We think of the core. There has to be a core, which is the banking system, which has to be safe and boring. Meaning that this is because banks create money. And this is something we often forget, that banks have the power to create money. So we need a core which is boring, which is less risky, which is doing much of the aggregation of risk. And then we need a periphery, and that periphery is the non-banking financial institutions that have that local knowledge and that are able to originate the risks and then transmit them to the core. So if you think about it in that way, then there are non-banking financial institutions in India that are already doing that work extremely well. Now, from time to time, you will hear in the news about a big failure of a non-banking financial institution. But for the most part, I would say that the non-banking financial institutions in India are doing a pretty good job of originating risks and transmitting them. It's the banking system, the core in India, which is weak. And so I think what we need to do is, first of all, think about, if you think about it at the systemic level, then this is one way to approach it. Is there a role for digital on the periphery, meaning with the non-bank financial institutions? Perhaps. But the other panelists have already said, it has to be an assisted digital story. Because the physical infrastructure is still needed to reach out to the last mile and also to create trust. And by physical infrastructure, I'm also talking about human beings. We need human agents out there doing the work of, and so both in payments as well as credit, I think that it's going to be a physical plus story. Now, the physical infrastructure itself is not working so well, as we found out during COVID. The cash out infrastructure in India at least to our estimation, has not really performed well at all. And it has not performed well for all sorts of reasons, for reasons that have to do with human failing and for reasons that have to do with infrastructural bottlenecks. So digital, I think we are making the transition to digital, but it's a long road.
You mentioned the credit boom as a result of liquidity. Just want to draw connections for a global audience. This is a real issue, certainly in a lot of wealthier economies right now, that because of government support, a bunch of banks decided that there was going to be a crash, took actions consistent with a crash, and then there was a lot of support. There wasn't a crash, and so suddenly banks are sitting on huge amounts of liquidity with not necessarily a lot of demand, and people asking questions like, how do we restart credit markets, and how do we make sure that credit becomes available to marginalized populations? And so, for those in the United States who are interested in this, I think there are some connections there. But also, Rashmi, I want to come back to you on sort of this credit boom idea, because that's also something we're seeing because of the fintech explosion and is related to the metrics that we use. That a lot of the excitement about fintech has been, oh, look, we've got all of these new credit institutions out there using fintech to deliver. And some of those took a big hit during the pandemic because they didn't perform very well, but there doesn't seem to have put very much dent in the growth. How do you think about fintech success in relation to the fact that a lot of fintech right now, the excitement is about all new ways of giving high interest loans to poor people?
Okay, sorry, Tim, there was a lot packed in there. So let's just pull on each of those threads. So the phenomena that you were talking about, where banks globally are sitting on a lot of deposits, it's certainly true even on the African continent. Corporates and people parked capital expecting the worst case scenario, and have not yet come out of the worst case scenario, also because there has been a depression in aggregate demand. And that's not the scenario under which they want to do expansion, et cetera. So there's reason for that. Now, there are a couple of banks, but I'll just speak to the deposit taking ones, whether microfinance deposit taking ones or commercial banks as such, have had partnerships, distribution partnerships, like the way Payal was talking about. But again, it's not. A lot of this depends on which market we're talking about and what role each of the partners are playing, right? So your fintechs can play the customer origination role. They can also play the role of actually the debt service piece of it, and the actual money to be lent out can come from a bank. Or it can be the fintech has able to lend out, prove that certain portion of its portfolio is actually not as risky as banks who are very conservative think, and then banks can buy out that percentage of portfolio. So there's a lot of models out there. However, what we're dominatively seeing is that a lot of the fintechs have been focused on two of the functions that Ida was talking about, payments and credit. And credit fundamentally is a function of information asymmetry. In very data thin markets where there is extremely high information asymmetry, you don't know anything about Rashmi, there's barely enough KYC, you don't have an understanding of her cash flows because digital transactions are very limited, you are going to pay the penalty for that. There's a massive risk premium attached to that. And especially if this credit is not collateralized. A lot of MFIs, et cetera, have cash collateralizations. Fintechs don't, they have a smaller, depends on how their model is. So they price all of that into it. And we see, so that's one aspect of it. The second piece, I read the paper and you guys did an incredible job, and I'm just going to overlay the Uganda piece on this, is that you cannot dissociate these functions from political economy. The 2-year T-bill rate in Uganda is 16%. That's the risk-free rate. That sets the pricing floor for everything else. And if you add that onto all of this equation, credit becomes very, very expensive. And that's why people are better off, actually getting credit from their SACCOs and VSLAs. Sorry, I don't know if that really helped the conversation, Tim.
Oh, it always helps the conversation because this is, it's a complicated thing. It can't be sort of reduced, and there are lots of different threads here. I do want to dwell on, these comments around regulation and metrics and, where the action is coming and how we, have a system that functions. So, I could ask infinitely complicated questions, but I'm going to try and narrow one down here. Payal, around this question about who gets served. So along the lines of Rashmi was saying, sort of information asymmetry. And, as I think about the development of payment systems that MasterCard is a huge exemplar of, that the original payment systems were incredibly exclusive and focused a lot on knowing exactly who was there and that there are no bad actors. It was tough to become a merchant who accepted credit cards 20 years ago, before Square and all of these people sort of, sign up with an email address. Getting access to the payment system was really hard because the frame was make sure that everybody in this system is legitimate and we know exactly who they are and can trace them. We've seen this growth of payment systems to a recognition of how important payments are. But it sort of obscures the fact that that is a real trade-off, that, the safety and security of the system and the ability to exclude bad actors, requires actually paying some attention and not just saying, you get an account and you get an account and you get an account and you get an account. So how do you think about, the expansion of the infrastructure of payments within financial systems that balances this? We need to bring a lot more people in, but we also need to make sure that the bad actors aren't those people that we bring in.
Yeah, I think it's a real dilemma where, and I think all of us are constantly trying to find that balance where we know that payments are fundamental to the global economy, but we want to ensure that we're doing payments in a responsible, regulatory compliant way. What I'm optimistic about is that there are opportunities to use, and of course, again, responsibly aggregated and anonymized, but using new flows of data to be able to help de-risk and help us understand who these individuals and micro and small businesses are so that we can not only ensure inclusion, but also making sure that we're catering to the right subset. So I think I don't have a magic answer for you, Tim, in terms of what the right balance is or how do we do it. I think it's just we have to keep a watching brief and making sure that we're not veering one way in sacrifice of the other.
Sorry, can I just?
Yeah, go ahead. I was just going to thank Bob for
just,
not giving a magic answer because I hate magic answers.
Just to add to what Payal is saying, there is, as she mentioned, there is a very, especially low income and emerging economies, there are some very hard choices. Let me give you an example. Like the Bank of Uganda took a so you have mobile money agents. We have about 200,000, and you can discount them because they serve multiple providers. So you're looking at 100,000 at least unique mobile money agents. But they grew to that size because there were only mobile money guidelines, not regulations. The central bank then when we had agent banking regulations, then because the central bank supervises all of the deposit taking institutions, had very strict criteria on who becomes an agent, who becomes part of this extension of the financial network. And that was, you needed to be an existing business. We need your business license. We need 1 year audited accounts. It was impossible for banks to find the kind of agents. And it became an unlevel playing field between bank agents and mobile money agents. And that, there's obviously so at some point we need to have the discussion on what is a risk-based approach to financial inclusion, to this expansion. And the second thing is, despite all of these amazing balances and checks, there is so much agent-related fraud. Either this fraud by the agent or customer putting a fraud on the agent. And so I just feel that maybe this is where, when we talk about digital, a lot of the back-end analysis, etc., can help trigger, say, these are the kinds of transactions, or we should be talking about cybersecurity, which the paper also refers to, cyber resilience and cybersecurity as a utility. Because if it's a utility, then we are able to figure out what is the most secure way for multiple participants to come in and think of the service model.
Can I just jump in? So I
Please.
love where this is going. Very interesting. And I totally agree that like expanding the system, the payment system for more players is the right path. And I think what Rashmi is saying, and I think what the paper says, and definitely what CFI says, is that the tools to ensure safety must change to adapt to this new, bigger system, this new, bigger pie. And I feel like this is where there is the disconnect. The tools that we're using are outdated, where you're still trying to put out regulations around, who is in and who is out, where maybe there are some other ways that supervisors should be monitoring potential concentrations of risk. And this is where I feel we have not, as an industry, done. We need to put a lot more attention on this. We need to do a lot more experimentation on this. So that's an area that I kind of would love to crowd in research, crowd in funding, because this kind of experimentation actually requires, subsidized public money to test some ideas.
So Mayada, I want to keep on that path, but quickly for the audience, I do want to mention there is a Q&A function. We are not going to have a specific Q&A practice, but one of our standard features of the faiVLive is questions that go in the Q&A. We follow up with the panelists for follow-up answers. And so please do feel free to put questions in the Q&A. I can draw inspiration from them in the conversation, but we'll also follow up with questions afterwards on a post on financialaccess.org. But Mayada, to this point, one of the things that I worry about a lot is the digitalization of traditional financial services providers to the poor. Basically, if we talk about microfinance in general, that their business model depends on scale and scope of who they're reaching, and to add DFS on top of their traditional work is a significant expense for organizations that are not all that profitable. But to the point you were just making too, the regulators need to better understand risk. In a lot of countries, I worry that the pace of digital innovation is faster than the pace that regulators can keep up. So we have a problem of both, how does the microfinance industry keep up with the pace of digitalization, but also how do regulators keep up with innovation? Do you think we can keep pace with digital innovation from a regulatory perspective?
I actually think it's not a choice. It's like you have to. It's happening, and the question is do you want so much harm to be created that then you're doing a cleanup job later? The US, we know what this feels like. So you have to. We have to do it, and the question then becomes how. What do we do? How do we do it? And that's why I always go to who are the institutions that are responsible, that have this as their mandate to work with governments, to support them, work with regulators, to support them to keep up. What are the role of, so this is where, multilateral institutions take an oversized role, because that's their core function. That's what they were built to do. This is where a lot of donors should be supporting the multilaterals to do this. Or if it's not directly the multilaterals, other actors that can serve that function. And I think what's happening is a lot of the donors are looking for, like they're drawn into this whole blended finance, bringing capital, incentivizing the private sector to come in and solve the problem, when fundamentally this problem is not a pure private sector problem. And therefore it's the tool not matching the problem. And so I would love more donors to pay attention to kind of the public good aspects of what is needed in a financial system to work well. And I don't think enough of them do that.
And
Tim, sorry, Ida, go ahead.
Yeah, so I was going to say, Ida, that's actually a great transition into some of what both the report, but also the United States has one of the more financialized economies, has probably more financial regulatory capacity than just about anywhere else. But at the same time, doesn't have a lot of answers here always, and all can be caught flat-footed, it seems like, on a number of occasions. So please, follow up with your comments, but also what lessons does the US have to offer in thinking about some of these transitions and inclusion?
In some ways, I was, even without that prompt, which is, I think, related, I would have kind of jumped onto your comment with almost some of the lessons about what not to do in other places. So the US, every time there's been a different kind of financial crisis, we've created another agency, right? We have a very complex state and federal different regulators for different institutions. And so again, as the who changes, but the regulators are still focused on a specific, it's like looking for your keys under the light, right? I regulate this piece, and I regulate this piece, and I regulate this piece, but only for these institutions. It's not only that regulators are, to the theme that's come up here, managing risk is their job. Innovation and keeping up with innovation is kind of almost antithetical to some of the culture of some of the regulatory agencies, and just the pace of change. So obviously we did a few years back, one of our fellows, Sean Duff, did a global scan of regulatory sandboxes and kind of like, what are different countries doing to get smart, get ahead of the game. I think that places like the UK, I'd love to hear other stories where they, it's almost like the simpler, the bigger the purview. Again, if you're focusing on the safety and soundness of the system for individuals, then you might be able to look across functions as a regulator. I think that we need to be having those kinds of conversations. I think that they're starting. I think AIR and other organizations that are coming up are starting to think about that. But in my mind right now, part of the reason the US is behind in some of the things where other people have been successful are because the regulatory calcification is so deep and so hard to imagine. Like in any case, once you open up a box, you don't know what's going to get put into the next box, right? So, and I don't think that the well-intentioned kind of sense that financial inclusion is the top priority is shared by everybody yet. So the idea that you break what's there to build something better has its own risks inherent in it, which is keeping people stuck. I would say that in other places that inevitably, when the expansion of financial inclusion was through telcos, was through other kinds of institutions, you're in a very different starting point about understanding what's under the umbrella of any regulatory function. So that's maybe it's a bit obtuse right now, but I do feel like we can't afford to not be having the conversations about what next generation reg tech and regulatory innovation looks like alongside the proliferation of product and services. And I think that the other thing that's not going to fit anywhere particular in this conversation, so let me just throw it in here now. And Rashmi, it goes back to something you said that at the very beginning of the conversation, which was people don't utilize formal financial institutions if they don't have income. And there is a reason right now that the banking rates in America, changed a lot in the last year. It's because there was huge amounts of cash transfers and people all of a sudden needed to have a relationship with a formal financial institution. So even as we think about the system reforms, the regulatory reforms, there's this whole other side of conversation that is happening around, if you really want to advance any form of inclusive financial system, let's also think about that routinely positive cash flow at the household level that's going to fuel the economic growth and going to keep this meaningful conversation going. So I know that's a side. I want to make sure we stay with the regulatory innovation piece as well, but those are my random thoughts for the day.
There is a specific instance of some of what you're talking about, Ida, that I think is going to increasingly at least be part of the conversation based on what I see, which is crypto, right? How do we regulate crypto? like whose responsibility is crypto? Who is responsible for consumer protection within the crypto framework that is supposedly sort of bypassing in many ways all of the existing sort of regulatory structures. And I'm one of those people who does worry always about breaking what's there in our rush to innovation, from people who are particularly don't understand how hard it was to build what was there in the first place. But I look at the crypto world and I think what poor people need when it comes to money and payment systems is they need stability, they need safety, they need comprehensibility, and they need something that doesn't destroy the planet. And so that's 4 strikes against Bitcoin in my reckoning. But I also don't want to sort of be egregiously wrong. So I want to throw the floor open to the sort of this question of, is there a role for crypto in this conversation about building inclusive financial systems? Or is it a distraction from the much more mundane blocking and tackling to close the last 30%?
Sorry, Tim, I'm going to answer this one because I had a comment on the regulation piece, which I thought was important. And the crypto comment is very short. I don't find crypto inclusive. So I don't know if it's relevant to this conversation. For rural women in Uganda who are not able to, who barely own phones, and digitally, it's very difficult to say how much money you're sending, because you can tell by the color of the currency. Crypto is just, you have lost them. You've lost everyone. So if we were talking about inclusive payment systems, and unless we are having a discussion on central bank-led cryptocurrencies, then that's a different thing. How are central banks leading in delivery of cryptocurrencies? Then that is going to happen. It's just the form factor and what is the implication and the inequality that may or may not come with that. So I'm going to sort of migrate to where Mayada and you had ended on the regulation piece, because I think that's very important. I see 2 big things that regulators will have to think about as they are playing catch up with innovation. One is trying to constantly assess systemic risks that innovations bring into the financial sector. And they are thinking of sandboxes, and like we've helped the insurance regulator, the central bank launch sandboxes, and they are using this test and learn approach to understand the business model better. But what is more important is the business of regulation is changing. For example, if I was able to get, say, because regulation ideally should be function related. If you're not doing deposits, you can get in Uganda a credit-based license from the Uganda Microfinance Regulatory Authority. You can be a fintech and just lend from your books, and you don't need to go to the central bank to do lending business, right? So you can get function-based licenses, that's one, but that also creates an opportunity for regulatory arbitrage. Because if I take money from the people, the principal, if I take people's money, I need to be heavily regulated because I owe people their money. Typically, people think of that as savings. But what if I was a fintech that was doing credit and offered fixed income securities? Then it becomes a capital markets license. And suddenly there is I have a capital markets license and I have a credit license from completely 2 different regulators. Nobody knows that I have is not speaking to each other. And there's great opportunity for regulatory arbitrage. So that's where the business of regulation will change, where suddenly financial sector regulators are going to have MOUs, have jurisdictions, and say, well, we will work together. We will see how to make sure that we are speaking to each other, and we are seeing that change. So that's one aspect that I thought that would change, and that then would have really good positive impact on consumer protection.
Anjali, but coming to you, certainly welcome any comment that you have on the crypto question. If it is quickly to say, I think it's a distraction, that's fine too. But, India has done more than many countries in terms of, creating different kinds of financial institutions and different functions with different regulatory regimes. And, I'd be interested in your take. Certainly it looks like has advanced in the financial inclusion conversation by creating lots of different types of regulatory schemes. So interested on your comments on the regulatory arbitrage that Rashmi is talking about, but the role and your thoughts on where India goes from here on on that periphery, the NBFIs and other related financial institutions in terms of regulation that both advances inclusion, but also provides some measure of consumer protection.
Yeah, no, so I will almost, I will say that everything that Rashmi said about Uganda almost identically applies to India. That cryptocurrencies are just beside the point as far as inclusion is concerned, because in India, certainly cryptocurrencies are mostly speculative assets that only the very rich can afford. On the regulation side, yes, I think that there is a proliferation of types of financial institutions, and that's both good and bad. It's good because you need different types of financial institutions for different types of services, but it's bad because you have this sort of proliferation of regulations and regulatory frameworks. And so a certain amount of rationalization is needed and aggregation is needed on the regulatory front. NBFCs, for instance, non-bank financial companies, are regulated much more stringently by the banking regulator than banks are. And yet banks are less safe, I would say, on balance than non-bank financial companies. So NBFCs, which are doing this important work of originating risks at the last mile, have their hands tied by too much regulation and too much capital requirements. They don't really need that kind of heavy-handed regulation. So I think, and I would say that part of the reason that NBFCs are regulated in this fashion is that the regulator sees NBFCs as competitors to banks, whereas NBFCs are really complements to the banking system. And the banks, and especially the public sector banks, their balance sheets are so bad that if the regulator were to basically impose capital adequacy requirements and ask these public sector banks to reveal their true financial positions, that whole sector would collapse. And so there is a sort of legacy interest in keeping some institutions alive that really should be dying. Now, recently India has also started talking about a bad bank and creating institutions that will resolve financial institutions that have gone bad. I just want to say one other thing. You know, there is a story in India that happened in the last decade, which I don't know if many people outside of India know about, and that is the story of payments banks. Payments banks are a specific kind of banking institution that were brought into existence in about 2016, 2017. And these banks were supposed to reach the last mile. They were not allowed to take advance credit. They were only allowed to take deposits. And their business was basically a transactions model business. The payments bank's story has been mostly a failure. And it has been a failure because, I would say, of regulatory blind. I mean, you know, it's the regulators have really not. I mean, the idea of payments banks is fantastic, but the regulators have, in some sense, crippled that idea in the implementation of it. So I think while India has had many different types of financial institutions, we haven't had much success in getting traction, especially with the last mile, and that is because the regulator, I think, has not done its job properly.
Ida, speaking of last mile, this is a place that the United States has been looking at the last mile for 30 years, 40 years, that if we look at the measures, and the measures are terrible. The definition of underbanked in the United States is kind of ridiculous. So for people from an international context, that there is officially something called underbanked in the United States, and you qualify as underbanked if you do any transaction with a non-bank. So you're sort of implicitly assumption that only people who don't have access to banks would possibly use a non-bank to complete a payment or to cash a check. But that being said, there's still a lot of people who don't have access to core, basic, safe, reliable, affordable financial services in the United States. If you were to, say, here's the one thing that other countries should be paying attention to as they close the gap, as you get closer and closer to the last mile, to not get stuck in this place the United States is with relatively little progress for a long period of time. Could you come up with 1, 2, 3 things to think about?
I'd pivot faster than the US did to an alternate success metric, honestly. Like, so that's part of it. And this is mentioned in the paper, we've talked about it here. The idea that the US is a success, you know, we've even seen from the IMF, there's a certain amount of financial deepening that correlates positively with growth, with economic growth. There is an additional layer of financial deepening that separates from and actually becomes a drag on growth. So I think to the point that we have overdeveloped our payment and credit muscle in the US to the exclusion of thinking about routinely positive cash flow for households means that the reason that we've had GDP growth for a while has been the ways that people have taken on level. We have transferred a lot of the risk of the economy onto household level indebtedness, which is a very different question than access to credit. Unproductive debt is now a real drag on so many people in the US. And again, it's not really coming into the conversation around last mile, because last mile is about offering more and more. There is not a really explicit conversation about what are the other tools we need in that, again, more broadly defined inclusive financial system. So all of that to say, and we've seen it not just here, I think that this is also in FSD Kenya, you can, with some of their research, you can have greater and greater inclusion and have poorer and poorer financial health and financial outcomes for households. That should be the bellwether for other countries to get on board sooner versus later with a much more, wholesome, fulsome understanding of what really facilitates financial well-being for a household, and for the broader financial inclusion community to kind of go where Indradeep has talked about and really embrace that kind of measure of household level stability, resilience, security, as what are the functions. And it could be that the incentives for fintech, like how they are subsidized, how they're, all of that is, again, something that, you know, is a lessons of maybe what to be skeptical about from the US. There's, anyway, I'm taking too much time with this, but that would be my sense. Pivot sooner.
And I feel like we could go on for another hour. I'm looking at, like, we've only been talking for 10 minutes, right? But it's, Ida, your comments, I think, sort of lead us into a good place to, you know, at least pause this conversation for ongoing conversations in other ways. But, you know, this question of what does the agenda need to be for the next 10 years, and what are the right measures for that agenda? And Mayada, I know that specifically that's something that you've been thinking a lot about, is what is the agenda from here, and what are those measures, and who needs to be involved in those conversations? So can I lead off with you and our sort of our around the horn wrap up on this question of what needs to change, and you know, what needs to change for these next 10 years, and what are the measures that we need to use?
Yeah, no, I want to just build off of what Ida said, because I love that it's actually a perfect transition to this discussion that you're taking us to, Tim, which is what can we learn from the US that can actually help us as we think about the future direction. And I would say one of the big lessons is when you measure financial health, unfortunately, the solutions are too narrow, and that's what has happened in the United States. We start focusing our attention on the wrong things. And what I've noticed in the United States is everybody sees the problem as people don't save enough. Household savings is the problem. But in this discussion, we've just talked about all the system issues that actually make people vulnerable, that increase risk to households. And we've heard the India story where, you know, safety nets are important. And when you have financial health as your kind of flagship measurement, you don't naturally come out with, well, what are the systemic problems that need to be solved so that poor people can be financially healthy. So it could be an outcome, but it shouldn't be the kind of the flagship metric that helps us determine what it is that we prioritize. So I don't think we know what the new measurement framework should be. I'll be very honest. I think we are often distracted. We've been distracted for a decade on this, transaction account measurement, which has, I think, derailed a lot of our attention. And I think we're now looking for the replacement indicator, and everybody thinks financial health is that. And I don't think it is, because I think it will take us down the exact same rabbit hole we spent a decade on. I feel that we need to be focusing on the broader concepts of well-being, and the broader concepts of what can financial services help people do with their lives, help them. How does the financial services help people get that cash flow and income? How does financial services help people build the wealth that they need that can protect them when there's a shock? And those are the kinds of things we need to get to, but we're spending way too much time determining whether, do we have the right indicators in a financial health metric? It's a waste of time.
Thank you for saying something explicitly. I am on the record plenty of some skepticism about the financial health language because of exactly this, that it tends to focus, it makes it easy to focus on individual choices rather than systemic issues, because we have this problem in health conversations, right? It's, is someone healthy often comes back to what do you eat rather than the public health system. And a concern there. So, I think, that is incumbent on all of us to make sure that we don't let phrases get co-opted and don't get distracted, as you say, away from, language that allows us to narrow and focus on things and get distracted from the bigger pictures and outcomes. And goes to some of why we haven't updated the name of financial access over time, is because the question is really, what are you doing, not what words are you using, and keeping away from that distraction. Payal, let me turn to you for some final comments on change and metrics.
Yes, absolutely. So I am less skeptical about the phrase financial health. I do think that is the direction of travel we should be headed towards. For me, it's looking beyond access, but also looking at usage, looking at trust. We haven't really talked about trust, and that is an incredibly integral component, I think, of an inclusive financial system. And we have to talk about capability. I think the key for me is that these outcomes are going to take way longer to measure. So we've got to figure out kind of what intermediate outcomes and outputs we can keep track of to make sure that we're on the right path. And the other thing I think we need, if this is a systems level conversation, I think we need systemic patience, because I think we get really wrapped up in what data we have at our fingertips, and we look at all of the analysis and insights that come out of it. And then, to your point, Mayada, we get distracted from, again, the direction of travel. And so to me, I think having patience, and one of the things I think we need to do is we need to think about how we measure collectively. I think there's so many fragmented efforts around measurement that, we're all duplicating and replicating each other's work. So I think one of the things that we could do better to build this inclusive financial system is actually collectively measure and share data, of course, responsibly and aggregated and anonymized.
Indradeep, what needs to change for the next 10 years in India, and how do we measure it?
Yeah, so I think, I'm also not as skeptical about the phrase financial health, perhaps, because I think that it gives it anchors, I'll leave everyone with a provocative thought here. There is a chapter Talcott Parsons was an American sociologist. Chapter 10 of his book, The Social System, he lays out what, the healthcare system and how the doctor-patient relationship works, And I would say that the phrase financial health is important insofar as it reminds us that in many respects, the customer relates to the financial service provider in many of the ways that a patient relates to the doctor in the healthcare system. And I think that questions of trust, questions of customer protection, can in fact take on a new kind of salience and meaning if we approach them through that lens. But so to get back to your question, I think for India, what is the proper regulatory framework for originate, transmit, aggregate, risks? And then I think one very important thing that the regulator has missed in India completely, and that's one of the reasons why a lot of these differentiated financial institutions haven't really taken off, is that the regulator doesn't understand the unit economics of financial inclusion. We can talk about customer protection, but if the unit economics of customer protection doesn't work for an FSP, you're not going to get it. And certainly the regulator has I don't think has very little clue about what really the unit economics. So I think sorting that out and figuring out how customer protection can be made feasible for financial service providers, economically viable, is a very, very important gap.
Thanks, Indradeep. And I haven't phrased it that way. I think that's a very useful way to talk about it. When I was reflecting what Ida was saying about lessons for the United States, what I would put in there is the United States has fetishized profitability and the idea that there isn't really a role that that the only reason we might need nonprofit providers of financial services is because we haven't figured out the right innovation yet, as opposed to if we are going to provide safe and secure services, there are some things that can't happen in a framework that requires every customer to be profitable. And therefore, there is always going to be a role in the last mile for subsidy or nonprofit or some other business model, because those unit economics are not going to work for, Rashmi, for your phrase, for the rural Ugandan woman who's judging, currency by color. The bringing that woman fully into the financial system is not likely to be a profit-making effort anytime soon. So we need people who aren't going to be so focused on profitability. That being said, Rashmi, I saw you laughing very much at the unit economics comment. So your thoughts on what needs to change and what are our metrics?
You've captured it really well. I was laughing because I was going to make the same comment as Indradeep mentioned, that most regulators don't understand unit economics. And when they come up with these, a lot of financial inclusion until recently has been a push strategy, number of bank accounts, number of mobile money wallets, and let's push out no frills accounts. And it's a very push strategy rather than what is it that people genuinely need, and are these affordable, meaningful products for this various segments of consumers. And what people and regulators don't realize that more often than not, genuine financial inclusion, the last mile, is a loss leading strategy, period. You need to have the very stable institutions, very strong, smart institutions, the right partnerships, or the right concessionary capital that comes in to first include people. Because there are two metrics that every financial institution watches: cost of customer acquisition, and second, average revenue per user. And if those two don't work, the model doesn't work, period. They would rather ignore the Ugandan woman and then focus everything on the capital city. So, coming back to what needs to change, I do think the metric of how we define financial inclusion needs to change. We're not taking into consideration financial depth. Or if you look at Uganda, all of this financial inclusion that we had through mobile money, there's zero depth. If you look at percentage of adults that have credit, savings, or insurance, which are key factors for resilience, it's very poor. Everyone has a payment channel, period. So I don't know enough, and I haven't certainly studied how the US has thought of financial health, as Mayada and you were speaking, but I'm not that big. It depends on how we frame it. But if we're able to frame it well, the determinants and the interdependencies, I'm fine with financial health. I don't know how the US does it, so I probably don't have too much comments on that.
This wasn't supposed to be a referendum necessarily on financial health, but I think what is really crucially important, as I think everyone has agreed, is what's the content and how does any measure get used? We can throw around any number of phrases, And always it's incumbent on us to make sure that we don't use those phrases to narrow in on things that don't really capture important. Matthew Sosurian in the chat sort of picked up on the public health question of the social determinants of health, which is something that often happens in public health conversations. And I think what a lot has been pointed to here is what are the rest of the determinants of financial health that aren't the household. The household is an important measure, but much of what happens inside the household is not because of what's inside the household. It's because of a lot of things that happen around outside it. I do want to pick up on this other question on unit economics and things that people don't understand. Before Ida, I turn to you for our closing word and some reflections on the report and this conversation, where conversations need to go. But the other thing that I find myself incredibly frustrated all the time is so much of the fintech conversation is only about the marginal cost of the additional customer, or the marginal cost of each transaction. And fintech is so cheap and it makes everything so much cheaper, and utterly ignores the massive and ongoing capital costs of the digital infrastructure, both the software itself, but also the human capital that has to be there to make digital financial services work and secure. Every day I see stories about very sophisticated companies getting hacked. And I think the people who are delivering last mile services are not as sophisticated as Silicon Valley tech firms that are getting held to ransom. Eventually the ransomware games are going to figure out, wow, there are a lot of transaction accounts there. There are a lot of people I can hold for hostage. And these are sort of ripe targets. And that's another part of this unit economics conversation, understanding what does the digitalization transition mean in terms of actual costs and ongoing costs, and particularly human capital costs. So that's my last soapbox thing. Before Ida, I turn to you for our last word. What needs to change? What should our metrics be from here? And how do we keep the inclusive financial systems conversation going from here? You're still on mute.
Thanks a lot. That's a loaded ending question. I would say this is the report's more of a commencement of hoping to inspire and seed a different kind of conversation about the future of financial inclusion, make it super intentional, as we're all so clear-eyed about what just happened in the past year in the pandemic. So when I think about this, two things happening. We put out this report. The Pia, who wasn't able to join us from the United Nations Secretary General Special Advocate's Office, also their working group on financial health just put out a series of reports on measurement, on policy, and on private market work. And when we think about the Inclusive Growth Summit in a couple of weeks, the whole goal here was to kind of bring these conversations back together. So we do focus on the outcomes of for individuals, however we define those outcomes. So we do that. So what? What then is implicated in terms of what systems we actually need to understand and need to understand each other to get there, right? So the beginning of the agenda, absolutely can't skip over the what's the what. And I love, Rashmi, your idea about the deepening, meaning how many of those dimensions of engagement are people using, that reaping the benefits of this full suite of services. If we get the metric there, the question is then, so what? So what systems? And then to me, I think the whole goal of the paper, and I think our hope for the conversation, is that if financial inclusion and financial health and this kind of hairball of terms we all use, and we don't need to compete with each other, if this construct becomes core to an inclusive economy, it means that other ministers besides finance ministers are implicit in helping to achieve that outcome. And so that for me is that the who understands the economic unit of the household, who understands the implications of this for a broader set of systems. I think that's where we need to go. And I feel like in some ways that's a cop-out. You want to boil the ocean, but it kind of isn't. We can do this. We can have these conversations. And I do think in some ways we've made it harder on ourselves in the financial inclusion field with all of our expertise and all of our acronyms. It's been an inside conversation, and we need to hold ourselves accountable to being relevant to a broader set of actors. And that's kind of where I hope that this will lead as we go into the future.
Thanks. Those are great closing thoughts. I had in my my notes a question that didn't get asked about financial inclusion not being sexy anymore. So I like to think of the summary of that as that we got to make financial inclusion sexy again for the rest of the world, and not just our financial inclusion insiders. That continuing this conversation, having an inclusive financial system is a vital part of a lot of other conversations. We have to join those conversations and invite those people into our conversations, and not be so narrow across this. So I'm amazed and grateful at being able to organize a group like this thoughtful, this willing to say tough and challenging things, and grateful to the very large number of attendees who have stuck with us for more than an hour of this conversation. I know all of you have every bit as much of Zoom and webinar fatigue as I do. So I really am grateful for so many spending so much time with us. As I've mentioned, we do a follow-up post for each of these posts that sort of summarizes what we've talked about, but also answer additional questions. So don't hesitate, audience, if there are other things you want us to touch on, that we will, you can send those in to contact@financialaccess.org. Or to me directly, timothy.ogden@nyu.edu, and we'll follow up with those. And I won't make a promise about when the next 5 is, but hopefully it will be soon. And you'll see some notes from this and some other ideas on moving the conversation forward. Thank you so much, Ida, Payal, Indradeep, Mayada, and Rashmi, for all of your thoughts. And we'll look forward to continuing the conversation and working with all of you to make families more included, the household unit more central and healthier, however we design higher well-being and healthier, and with access and inclusion and all of those words that we'll throw in there. Thanks again, everyone. I really appreciate your time and being here. Take care, everyone.
Thank you all.
Thanks, Tim.
Thank
Thanks.
you.
Bye-bye. Thanks, everybody.
Bye-bye.